Banks don't want you to know this, but every single day they take your deposits and lend them out to someone else at a profit. And that someone else? They're getting richer off it. Today, I'm flipping the script. I'm showing you how to stop being the deposit and start being the one who borrows smart and comes out ahead. I'm Mervin. This channel is about making money make sense. No fluff, no jargon, just the moves that actually work. Let's get into it. First thing you need to unlearn. Debt isn't automatically bad. Bad debt is money you borrow to buy something that loses value or gives you nothing back. A vacation on a credit card, a car that depreciates the second you drive it off the lot. That kind of debt just drains you every month. Good debt is different. It's money you borrow to buy something that pays you. A rental property, where the tenant covers the mortgage, or a loan that funds a business, generating more than it costs to repay. With good debt, the asset pays the interest, not you. Here's where it gets interesting. Leverage. Say you've got $20,000, put it straight into the stock market, and a 10% gain hands you $2,000. Solid, but not life-changing. Now instead, use that same $20,000 as a down payment on a $100,000 property. The bank covers the rest. If that property goes up just 10%, its value climbs by $10,000. And that's a 50% return on your actual cash. Plus, if it's a rental, you're collecting income the whole time. Same amount of your own money. Completely different outcome. That's the power of using someone else's capital to grow yours. None of this works without one thing, your credit score. Think of it as your financial resume. A high score tells lenders you're low risk, and low risk gets you the cheapest money on the table. A low score means you still might get the loan, but you'll pay a premium and interest that eats straight into your returns. The gap between borrowing at 4% and borrowing at 10% isn't small. It can be the difference between an investment that pays you and one that quietly bleeds you dry. Protect your score, pay on time, keep your utilization low, and check your reports for errors. It's the cheapest insurance policy you'll ever have. This next idea is the engine behind the whole strategy. The interest rate spread. If you borrow at 6% and the asset you buy only returns 5%, you're losing money. Full stop. But if that asset returns 12%, you pay the bank their 6%, and you pocket the other 6% as pure profit. The entire game is making sure what you borrow costs less than what your money, or the asset it buys, actually earns. Simple math, but it's the line between building wealth and slowly sinking under payments. Here's where most people get it backwards. They borrow to look rich. A new car, a bigger TV, a nicer wardrobe. None of that pays them back a dime. It just quietly drains their paycheck every month while the bank profits off the interest. The wealthy borrow differently. They borrow to buy things that produce income. An apartment building, equipment they can lease out, a business that scales. The rule is simple. If it doesn't put money in your pocket, don't borrow for it. Save for it in cash instead, once your assets are already paying you. Here's something most people never do. Negotiate with the bank. Walking into a bank can feel intimidating. Marble floors, big desks, all designed to make you feel small. But remember, banks sell money. They're a business, and businesses need customers. If your credit is strong and your numbers are solid, you're not begging for a favor. You're a customer they want. Shop your loan around. Get quotes from 2 or 3 lenders and let them compete for your business. Rates, fees, terms. Almost everything is negotiable when you're not their only option. Now, the warning label. Once banks see you handling credit responsibly, they'll start offering you more. Bigger limits, easier approvals, tempting lines of credit. This is exactly where people go wrong. They take that access and start funding lifestyle purchases with it. Remodels, vacations, upgrades, instead of income-producing assets. The line blurs, and suddenly you're using debt to fund spending instead of wealth. The rule to protect yourself: only borrow for something that pays you back. If you want the vacation or the new kitchen, let your assets earn the cash first, then pay for it outright. Once you've got one good deal working, it's tempting to go all in and stack 10 more immediately. Slow down. Smart borrowers keep cash reserves on hand, enough to cover several months of payments if something goes wrong. A vacancy, a slow season, a rate hike. None of it should put you in a panic if you've built in a buffer. And when you can, lock in fixed rates instead of variable ones. A fixed payment stays the same while everything around it gets more expensive over time, which quietly works in your favor. So here's the bottom line. Debt isn't the enemy. Reckless debt is. Use the right way for assets that pay you at rates you can beat with a safety net underneath you. A loan can become one of the fastest tools you have to build wealth. The banks have been playing this game a long time. Now you know how to play it too. If this helped, hit subscribe. New money breakdowns every week. See you in the next one.